Prakash Diwan now joins us. Good afternoon, good afternoon, Prakash. First, a view on Infosys and IndusInd Bank, the first two companies that have declared numbers quite strong, at least on the Q2 operational basis.
Yeah, absolutely. I think both these companies have flagged off sectorally a good start for the earnings season. IndusInd on Friday was encouraging enough for given the fact that it has been performing well on a slightly larger or a growing balance sheet, which is commendable. And given the focus that it has on the retail side of the business, it was commendable. Revenue growth as well as expansion on margins in these environments is always commendable. But I'm surprised at the reaction of the street. Infosys particularly, today there's nothing very upsetting about the earnings. If you see the metrics, everything seems okay. It's just that the guidance is probably more real this time around. And then the fact that management has guided more realistic numbers going forward and not, lofty stuff all the time, which you could expect. People need to put that in perspective. And my sense is Infosys is as good as it could get. And they are very encouraging numbers, if you ask me honestly. But maybe the reaction could come, the positive reaction on the stock could come a bit later once they see some other numbers come through. So maybe the day TCS comes up and that's disappointing, Infi numbers will start looking better.
Right. What do you make of the valuations of both these names? You think that these two names have been relative outperformers in their sector? That's why a positive surprise was expected, and that's why the reaction is muted.
Yeah, I mean, in both the cases, if you see particularly Infosys, the expectations are pretty high, and every time there's high expectation, there's always more chances of disappointment and this kind of a reaction. I would believe IndusInd is probably one of the best new age banks that you would get. So from a valuation perspective, if I were not to rate it as high as a let's say a Kotak at 3.5, 3.25 price to book value. Even if it were to be done at about 2.5, it's definitely got a target of about 1,080, possibly 1,100 neighborhood. And for Infi as well, if you see the kind of new dimension that it has started, the new dynamism that we started seeing out of this company, I don't mind rating it at least a couple of notches higher than its historic averages for the last couple of years, which means that from a valuation perspective, given constant currency earnings to be where they are, a target of about 1320, 1330 is reasonable enough to expect. So it's really not something bad, but it's a good opportunity to buy on dips, both these stocks, given that they do give a market leadership of sorts and representation.
So, for something like an Infosys, you think there would of course be a lot of trading activity today because it's an event and, people would try to make the most out of it. You think once it settles down, long-term investors would come in? I mean, the deal signing was quite strong. I mean, it does give you visibility of results going ahead, maybe if not in H2 and maybe in quarter one of FY17, as well as the margins were at the higher end of the guidance. So you think overall, once the fraud settled down, we would have some rationality coming in a name like Infosys? Certainly.
That's what I said. The numbers will start looking better when people take a reality check and not look through a colored lens of high expectations. And given the high build-up on futures and option activity that we saw in Infi going into earnings on Friday, there is bound to be profit booking, which could be fairly severe at times, and there was a lot of build-up, so that profit booking does tend to kind of, everybody scrambling for booking profits tends to have this kind of an effect technically on the stock. Maybe tomorrow, day after, things could start looking better, and there will be long-term investors who will see value in this stock, and there could be switches from some of the other players that people have been invested for the last couple of years.
You think going into the result season, overall market is decent at 8200 levels, or 8140 where we are?
There is this whole expectation that results will not be very great. There will be a tepid set of numbers. I think we've already seen bottoming out of numbers in the last quarter itself. If there is anything, there could be a positive surprise in numbers this time around, Pankaj. And my sense is from that perspective, we are not at a stretch valuation. Markets could actually, once they clear this 82.25, 82.30 congestion zone that my colleagues in the technical side tell me, it'll pave the way for a lunge forward to that 8400 mark as well. So markets are raring to go up. There is buying that's happening from the FIs again in a significant way, while the DOMs have been selling out at higher valuations, but earnings could probably start making the market very stock specific. So the day you have results like Infi, which is a huge heavyweight heavyweight on the market, almost 8%. And if he gets this treatment, naturally you don't expect the market to go in the other direction. So once these heavyweight numbers are out, I think somewhere towards the end of this month, you will start seeing markets move into a slightly higher zone. So I think it's absolutely a great market to buy into on a stock specific basis, even at 8150, 8200 where we are.
Right, and the point that you made about FIs buying, so you think that FI buying overall, it largely has not been very, very aggressive, but do you think at least the aggressive selling is now behind? Maybe they may not be buyers for the next few days or so, but overall, majority of selling, is that behind from us?
It seems like, and typically, the selling, typically the way the cycles go, you have a selling which is mass, which is, almost seeming irrational across the board. Doesn't need triggers on certain sectors or stocks, but you just have an exodus of sorts. So after that, you have specific trigger-based, news-driven selling, event-driven selling, and then of course you have a consolidation that happens where there's not much of selling or buying, and then a little bit of an uptick on the buying side. So we are going through that buying phase right now, and my sense is people will wait for good numbers, good guidance, good visibility of numbers going forward from every quarterly earnings announcements, and buy into those stocks. So this is a season to watch what to buy rather than what to get out of, because people have got out of everything and anything that seemed slightly iffy. This is the time to rebuild your portfolio. The number of stocks and if you see positions in most portfolios in September end are extremely light. The data is yet to come out, but the early round of data that we've seen from some of the mutual fund portfolios clearly tell you September was a very light month. People have lightened most of the weightages, and this is the time to rebuild that.
Last week, was an interesting thing about what you pointed out. Globally, not only here in India, we saw a lot of risk on trade happening, and so metals rallied, power rallied, emerging markets as a basket rallied versus the DMs. You think that this shifting would tend to continue, or this is something that you would not rule out to continue?
Well, I think it was a coincidence of the US dollar weakening out against emerging market currencies and crude kind of flagging of some sort of a value buying at completely bottomed out levels. So typically we've seen every time the commodity complex moves up, it starts with crude, it moves into oil and natural, of course oil and gas is the first one, then you have metals, then you have precious metals, then you have power, then you have of course the other commodities on the agro side participating. So that's a cycle, and it could probably last a bit longer till crude remains a little bit firm or has expectation of further firmness and the dollar remains weak. Any data coming out from the US which gives strength to the dollar will probably put an end to this commodity rally. But till then, I think we could be in fine fettle.
Let's talk about some names. Any other mid-cap, small-cap name that you've identified recently? Any new initiation that you've been looking at?
No, so what we are very clearly seeing is a revival in interest levels in certain sectors, Pankaj. Like we saw realty come back of, in a way. We believe that will continue to deepen and broad base. Specifically, we've seen the likes of Oberoi Realty, Godrej Properties, Sobha. They've offered very good value to investors. At these levels also, if somebody were to look at considering fresh entries, they do offer a decent upside potential from here on. So a disclaimer is I have personal exposure to Godrej and Oberoi both, and our clients would also be exposed to these names. On the mid-cap side, I think the other area which looks promising enough is the logistics part. The logistics area is again a buzz, though the numbers haven't yet come out, but I am very confident of good numbers come through. And one of our top picks from the mid-caps is consumption theme right now is CCL Products.
That's the coffee company.
That's a coffee company. I think once CCD comes through in the IPO, there'll be a whole revival of sorts for this entire space. You will start, according premium to other players, also ancillary players in the industry, and CCL happens to be one of the key ones. So let the CCD IPO go through with an overwhelming response, which I believe it deserves and it will get. You will see that kind of a thing for CCL also, which will be a mild re-rating upwards.
Right, CCL Products. It's a name which has also done very well, right, Prakash? Over the last 2-3 years, it's a name which has done very well, right?
It's been very consistent, hasn't disappointed, doesn't really, give you those sleepless nights with the volatility that you see in some of the mid caps. I mean, here's a mid cap which is qualitatively far more superior and resilient to, that category as a whole. So you could be rest assured you're buying into good value if you buy at lower levels, and there is visibility of earnings, a good management to back things up, and a segment that's possibly insulated from what happens to the dollar and what happens to crude.
Can you just tell us what is the valuation it is trading at? You can see the price over there, 243. What would be the valuation around?
So, one of the reasons why CCL has been in this band from 220 to about 250 for a fairly long time is people haven't yet decided to mark up the P multiple beyond, so FY16 for instance, this would be trading at just about 13 times. Because the reason is the expectation on earnings from this company varies a lot within, various analysis. The possibility of this company surprising on the earnings side is huge given the tax breaks that it has in some of the other countries that it operates out of, particularly in Southeast Asia. And the kind of market development they've done, helps them fetch margins, particularly in the first few years of their supplies to clients, and which is primarily there's one large client all of us know about that they supply to. And as long as that client keeps on expanding, they ride on that growth curve. So in the first few years, there's good margins to be made. And if that expansion keeps on happening, CCL, does EBITDA of almost 38 to 45%. That's a band. So with those kind of margins, I think it's a great story. 13 times is really not expensive. FY17, it could be available at about under 11. So there you have a company which has enough headroom for a P re-rating or a P multiple change. Forget about EPS growth, which is anyways there. So that's where we look at this to be a multi-bagger in the next 3 years. It could probably be 500 in 2.5, 3 years.
Prakash, let me tell you this. You are largely saying it can be a re-rating candidate. Growth would continue. Valuations are decent, but compared to the historic averages, valuation would be fair. It would not be cheap. It would not be expensive.
Yeah, it hasn't changed much. So there's not much of debate in terms of that. It's already over the top. It's expensive. Right. Nobody talks about it as expensive also.
Right. So just a word. What has happened to the tire names? Tire names have suddenly been started to look at, look like branded FMCG plays or branded consumption space. But the risk of rubber prices going down is something which is ignored. You think similar thing for CCL products can happen where it will be looked as a branded FMCG name and people would start to forget that, coffee prices can be quite volatile when the growth continues or 3-4 quarters, you see continuous returns coming in?
No, very, very sensible question. I'll tell you, while it... underlying this thing risk remains on the commodity because that's what it supplies. The pricing structure that CCL has with this client is really with Starbucks particularly, that's what you're talking about, is not, it predicates any changes in the commodity prices and it insulates CCL more than it does the client. The reason is it's not selling, necessarily under its own brand, but it's more to do with, the Starbucks specification that CCL caters to. CCL would also have to invest a lot into building its own brand. So this is a commoditized business, but with a lot of specialization because of the formulations, the know-how that goes into preparing those formulations. So I think it's a wonderful combination where it relies on a commodity, but it doesn't face the entire risk of the commodity being very volatile. So even if coffee prices were to go down or to go up, it really wouldn't change or alter the earnings profile for CCL dramatically on an immediate basis.
Right. Just the last two questions. First, you said that about CCD Enterprises. You think that they would get a good response? Have you done any analysis? Do you like that name? And secondly, about CCL products. Would it be a better way to place CCL products rather than Tata Global Beverages, because you get a lot of other businesses, even if you would want to play Starbucks or the growth that they are looking at in India?
No, I think while Tata Global Beverages is a great model and Starbucks is a great franchise, particularly in a market like India, the stock hasn't had the propensity to deliver much. So I would rather wait for that to happen and then ride on and not kind of run out of patience by investing into it, which people have done that in the past. So I particularly don't like that stock for that reason. Nothing much against fundamentals there. On the CCD IPO, I think it's a great model to invest into. I mean, we know that it hasn't made great money as yet, but these businesses do take time, especially at the rapid pace at which CCD has expanded. And then along with that, there's a misgiving that you are getting a lot of other businesses which you don't want to own. Why would you want to own a business which is also profitable? I mean, you have Sikal Logistics, which is again, for a large part is captively used by CCD, profitably so. You have a SEZ business, an IT park called Tanglin Properties, that's part of the group. You have a resort and leisure business that's at a high premium. You have a financial services business also, which I think is profitable enough and in the right spot. So all put together, I think it's a great combination. You're buying into a holdco which has a predominant share of the coffee business, which is what you would like. And once this leverage, this deleveraging is initiated, given the proceeds of the IPO, I think it will be magical in terms of, the way it can throw up a lot of cash on profitable basis. So the return ratios will improve dramatically from this tipping point. So people need to be just cognizant of that fact and buy into a marquee brand and wait for it to deliver.